saved more, invested more in education relative to those who hadn't, and it actually held true for 5 years.
I like that. It's kind of leaning into behavioral economics and thinking broader than just you know, the way that we would normally go about this.
So is this like just casual like reading, or is this like Clockwork Orange, where they tape your eyeballs?
Whoa.
I mean, hopefully casual.
And does it matter the movies? Like if I don't know, like if I go watch like The Big Short or something, does that get me there?
I think we need to go to Starbucks and get Remain some eggs.
Yeah.
What do you think about it?
This is fascinating. We're having a good conversation.
Well, you know what? Let's bring in Tyler Cowan to answer that.
Talk about,
let's talk about Starbucks because it wants to increase foot traffic in the afternoon hours.
Scarlett?
Did I what?
Are eggs going to make me smarter, Scarlett?
Eggs will make you want to go to Starbucks between lunch and dinner, which is what they want you to do.
Hey, production team on the TV side, no more coffee for Remain. After 11, no more. I thought we got the memo here.
Take note, right?
Yeah.
Yeah, the solution that Starbucks is proposing here is to boost its food business. It's expanding its food menu, adding 2 egg dishes, Remain, chicken, maple butter, and an egg sandwich. Also some other things like a potato, cheddar, and chive bake as well.
And then go to your cardiologist who will tell you not to eat it.
Yeah, I'm not feeling that. But is this the idea that this is going to get more people in Starbucks?
Yes.
Because last time I walked by a Starbucks, it looked like there's no more room inside there.
Did the whole alcohol at Starbucks thing not work out that they tried a few years ago? Do you remember that?
I don't know. I feel like they tried something. Didn't they put like olive oil in the coffee last year, and now they're trying this?
Was that butter or olive oil?
Starbucks owns the mornings, and the problem is they want to get people in later in the day. It's kind of like, remember what McDonald's did with all-day breakfast a few years ago, right? Try to get those people who come in for breakfast to come in later.
Interesting.
Hey, who knew? I didn't know this. The breakfast lineup over at Starbucks, I guess it accounts for half of the region's food business and about 8% of Starbucks' total revenue. So it's a big mover, right?
Yeah, it's a growth driver.
Yeah. I don't know.
People really like those egg bites.
Maybe you should just reduce the prices of the coffee. Maybe people could.
No,
that is not a way. That is not a way to increase revenue.
I'm getting nods in our studio that maybe.
From Starbucks' perspective,
you could just go to like the bodega down the street and for like $1, get coffee.
Exactly.
Or
that's what I'm talking about.
At Bloomberg.
Real New York
At Bloomberg, cost me nothing.
Bagel.
Just saying.
Be like a third of what you pay at Starbucks, but.
All right. I don't know.
You're fancy.
Isn't it amazing? We had a conversation. We didn't even mention the Fed minutes. How'd that happen?
We'll do that in the next hour.
All right. Promises, promises. All right, guys. We'll go get some eggs and
therapy,
and we'll be back at
I like that. Eggs and therapy.
Time. We'll join you, our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. We'll see you for Beyond the Bell at 4 p.m. Wall Street time. All right, everybody, we didn't talk about the Fed minutes with the team over at our TV side, but we are going to talk about it right now because for me and Tim, we were just talking about it. It felt pretty hawkish, but we kind of got that all laid out in that last Fed meeting. So let's get to it and take a look at the economic Fed and market backdrop. We've got a great team here, team.
Yeah, Bloomberg News markets reporter Abigail Doolittle is here in our Bloomberg Interactive Brokers studio, along with Bloomberg News rates reporter Michael McKenzie. Both with us. We got a little party for the new year here.
Happy New Year.
First up, the news of the day that you mentioned, Carol, FOMC minutes coming out about 1 hour ago. We did get a little bit of eco data. We got more coming up later this week. Abigail, I want to start with you and just sort of the quick equity market reaction that we saw at 2 o'clock, and also your interpretation of these Fed meeting minutes. Do you agree that they seemed a little more hawkish than the way the market interpreted the meeting?
I'm with you and Carol, yes. They seemed a little bit more hawkish, but this is classic Fed, at least to my interpretation. They love to play both sides and then see where the market goes with it. So you put out these slightly hawkish...
It's a strategy.
It is a strategy,
right?
absolutely. Yeah. It's jawboning, but through statements. At least just that's my thought on it. So you had Jay Powell, who at the beginning of December was sticking to the higher for longer, then at the meeting, fairly dovish or accommodative, and now you have the minutes coming out and they're a little bit more hawkish. I tweeted them out. Fed officials saw policy remaining restrictive for some time. Several said rate could stay at peak longer than anticipated. This one was super interesting to me. I'll be curious to hear Michael's interpretation of this. Officials acknowledged projections show cuts by end of 2024. Of course they have to acknowledge that. That is what the dot plot says. But I just feel as though they jawbone amongst their statements.
But not necessarily 150 basis points of cuts,
yeah, no,
right?
they're at 3 cuts.
Yeah.
And on this, the S&P 500 is basically where it was before, down 0.6%. I said to one of our colleagues, Terrell, on our markets team, who sits right near all of us, that I wouldn't be surprised that by the end of the day, if you see stocks down 1%. That said, we're still kind of just around 0.6%. So what the Fed is learning, if I'm correct in terms of this strategy of putting out different messaging and seeing what the markets do, it's not doing all that much, frankly. We were bearish coming in. We're down 4 days in a row. The dollar's up 4 days in a row. This is just a little bit of mood music.
I feel like data dependent. Like we're going to see what the
Yes.
data points say in
Yes.
helping us figure out the Fed's next steps. All right, Michael, you got to come in here. Here. What was your read in terms of what we got from these minutes?
I think it was pretty balanced, and in fact, I think, yes, it looks hawkish in some respects because they talked about financial conditions had eased, and that could be problematic for them to get inflation down if that continues. So that's the sort of standard stuff you get from the Fed. But it's interesting they're talking about slowing the pace of QT. They're talking about the balance sheet ending. This is all part of how they stop and pivot. And so they're sort of already laying that out. I mean, they're hedging their bets and saying, look, we think 3 rate cuts are reasonable, and I think that still comes through the minutes. They don't really want to over-tighten here. And they know that as inflation's coming down, they've got to start bringing the funds rate down. And this is a delicate dance they're going to have to do. Now, the bond market obviously thinks, well, if they're going to do 75, they could easily do double that. And the market is still pricing that in. And initially, we saw the bond market sell off, particularly in the 2-year after the minutes landed.
Right.
We're now back unchanged in the front end, slightly lower. We're lower in the 10-year yield. So earlier this morning, the 10-year got above 4% when we got the JOLTS number, just before JOLTS and also the ISM manufacturing. We were below 390 when I just left the desk on the 10-year.
Yeah.
So it's a market that's
We're at
moving
390
around a
right
lot.
now.
Yeah.
Yeah.
It's moving around a lot because I think we had a huge rally late last year, same in stocks, the everything rally, and people now just trying to reposition because we've got that big jobs number on Friday.
Because I think what was interesting too at the end of last year, we were talking about, okay, huge rally, felt like the risk trade was on because of expectations of an aggressive Fed cutting rates. On the other hand, when you look at what's going on in the bond market, that expectation that if the Fed has to be that aggressive in cutting, then there are things coming undone more rapidly than expected.
Yeah, you got that anxiety, and you can see it in the Fed minutes. They don't want to over-tighten. The bond market knows they can't over-tighten because what the Fed wants to do is pull off the immaculate soft landing. That is so difficult to do, and there are people who even debate whether 95
It's kind of amazing
was
where we
a true.
are.
Yeah,
We're getting, feels like
I mean,
close to it.
I mean, I spoke to an investor yesterday who said a year ago we all thought there was going to be a recession. Now, he said no one is talking about that now, which means from his perspective, he thinks that's the big risk now. We could actually get a harder landing because no one's thinking about that and no one's really positioned for that.
Is that a contrarian? Is that just a purely contrarian take, or the fact that people just don't believe it's going to happen, so they're not preparing for anything like that?
His moral is that he was really surprised that people no longer are talking about recession risk.
And I'd like to jump in for just
Yeah,
a minute because
please.
this is something interesting that I've been talking about over the last week or two, because both of our commodities experts here at Bloomberg, Mike McGlone and I think it's Vincent Piazza, I know his last name is Piazza, but they've both said that last year, it's really interesting, if you take a look at the Bloomberg Commodity Index on the year, it was down more than 10%. The S&P 500 was up 25%. When you have that kind of divergence, it's not great, just even from the standpoint of just looking at price. But when you think about commodities being down, they're saying it's because of a lack of demand. They think that slide in commodities is a sign of some sort of economic weakness ahead. So I don't know if the Fed is going to pull off the soft landing, although maybe it's a soft landing if it's a soft recession, and maybe they're counting on it, because there's no way that the Fed economists are missing what our own Bloomberg intelligence. So you just think about their strategizing around that, because last year when there were cuts priced in, and the only way I could make sense of it is if there was in fact going to be a recession, that they would cut. So it's almost like a meeting of minds in a strange way here.
And yet, in the Fed minutes, they say that further rate hikes remain possible if the economy warrants them. I feel like they cover.
Gotta love it.
They have to cover the bases.
Yeah,
I mean,
they
they
do.
They're like, got that for the Hawks, got that for the Doves. Like,
Yes.
they did it all.
Yes. So, Abigail, how do you explain the discrepancy that we see with what the market expects, 150 basis points this year in rate cuts, versus what the Fed is telling us could be on the table?
Well, I mean, as you both know, and I think you probably have not heard me say this, Michael, but last year and the year before, I mean, the bond traders were really just so wrong for so long. The stock traders were actually listening to the Fed. I mean, Fed Chair Jay Powell was very clear in terms of saying, we are going to hike, we are going to sacrifice the economy if need be, we're going to do anything we need to do to get inflation wrong. And bond traders just went against him. So the fact that bond traders are maybe overdoing it a little bit now in terms of cuts, like, that's not too surprising to me. Would it be surprising to me if in 2 months they're with the Fed at 3 cuts? No, not at all. Who knows? Maybe this time they're going to be right. And historically, you know, it is always the credit traders who are like the smarter side of the house. But over the last 2 years, the bond traders really have not gotten it. Now, that said, from a trading standpoint, I think that some of them made tremendous money on the volatility.
How important, Michael, is the Friday jobs report?
It is important because it's going to give us, it's the next piece of data that tells us whether or not a March rate cut is potentially coming. And I think this is a bond market that knows from history there comes a point where suddenly the job market just stops. You get that negative payroll print. And I mean,
Did JOLTS data give us any indication?
it's showing quits rate dropped. So less people are quitting. It's this so-called take this job and shove it indicator, as some people say.
Yeah.
And so people no longer feel confident about quitting because there's something better for them to go to.
Right.
That kind of tells you the market, it is tightening up now, the labour market. And that's what the bond traders have been looking for the last year and a half as the Fed's been raising rates. When does the economy really start to feel the lash from rate hikes?
What's kind of in a normalized economy? What's a typical number of jobs that should be available? Like, what would the JOLTS show us?
I mean, I remember economists telling me that the U.S. labour market grows around 150,000 per month just naturally. So you kind of got to cover that. There's like a natural growth rate.
Okay.
So, but I'm not really sure.
So, Abigail, on Friday, we're expecting 170,000 change in non-farm payrolls. Still a pretty robust number. What are your expectations going into it?
Well, it's interesting to hear Michael talk about that surprise drop because I can remember that both when I was in finance and here at Bloomberg, where all of a sudden there's a crazy number that comes in where jobs only grew by, like, say, 70,000 or something like that, and people are expecting the 170 or 250. So that can absolutely happen. We've seen that happen. If that happens, Michael's absolutely right. In my interpretation, the bond traders will be vindicated, and then you'll see probably a risk asset rally, and you'll see bonds continue to rally, and probably more cuts baked in. One thing I would say is just technically, the dollar looks like it's set to rally back to where its highs of last year. If that happens, and I don't know what the reason for that would be, maybe that suggests that the job report is going to maybe not hot, but will come in line, or some of the other data. But it looks like there's going to be dollar strength. That typically is negative for risk assets only because they're denominated in dollars. It's not always the case. You can have times where the dollar climbs in a healthy environment with stocks, but
higher rate environment, right? You tend to, it's certainly supportive of the dollar. Just got about 30 seconds left here, Michael. I mean, we've made incredible progress on inflation, correct?
Yes.
How close are we for the Fed in terms of those numbers that it watches? We're there, or depending, I know there's like so many different metrics in terms of how we measure. 20 seconds, is the Fed pretty close?
I think they've still got a ways to go, and I just say that from someone who goes shopping every week, and my food bill's not coming down, my insurance isn't coming down, nothing's coming down, so... And I got a 15-year-old at school, so I think the key here is going to be, as other people have said, are they comfortable cutting rates when inflation is, say, below 3%? Or do they want to see it get to 2%? That's the kind of unknown thing here.
Got to run, but I talked about how expensive my Christmas tree was this year. It was crazy. Abigail Doolittle, Michael McKenzie, you guys are a gem. Thank you so much. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow, the S&P, NASDAQ, all declining right now. Throw in the Russell 2000 as well. That index now down by just about 2.5%, leading the way lower on the Russell 2000, down now by 52 points. S&P down 31. That is a drop there of just about 0.6%. Dow Industrials down 230 now, down 0.6%. NASDAQ, the composite index, down 155. That is a drop of 1%. 10-year yield 3.90% right now, with a 2-year that's yielding 4.32%. Traders are sifting through the minutes of the Fed's last meeting to see if wagers on rate cuts have gotten too aggressive. Spot gold down $18 the ounce, down now by 0.9%. West Texas Intermediate crude now surging 3.8%, back above $73 a barrel. WTI 73.07. Cannot ignore the move in Bitcoin today, down 5.2%. As for the Federal Reserve, Constance Hunter is senior advisor at Macro Policy Perspectives.
What we need to focus on is what's happening with the data, and what we need to understand from the Fed is it only inflation, or are they taking into account a slightly softer economy coming off of that blockbuster Q3, slowing down in Q4, and what we anticipate is going to be a little bit slower growth in Q1.
And she was interviewed ahead of those Fed minutes. You can hear more of the conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Amazon's push into video advertising will boost annual revenue by as much as $5 billion. This according to an analysis from Bank of America. We've got Amazon shares lower now by just about 0.5%. Recapping stocks lower, Fed Wednesday, S&P down 29, down now by 0.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, folks, in case you weren't checking out the calendar, in just about a week from now, we're going to kick off another quarterly earnings season.
Finally. I've been saying it, it's been forever since we've done earnings.
It does feel like it's a long time ago. Except they kind of
they trickle out all the time.
There's retail, and then there's
I'm excited.
Anyway.
This is what we live for, Carol.
In just about a week from now, a little bit more than a week, we're going to get earnings from the big banks, the U.S. big banks. With that in mind, it comes at a time when some are going through a major overhaul. Think Citigroup. You've got another, J.P. Morgan, the lone Wall Street bank whose CEO was there during the great financial crisis of 2008, Jamie Dimon. He's still there. JPM shares, by the way, hitting an all-time high for the first time in more than 2 years. That was yesterday. And then, Tim, you've got another bank, Morgan Stanley. It's got a new CEO.
Yeah, this follows news last May that James Gorman would step down after a 14-year run in which he reshaped the Wall Street Bank in the wake of the financial crisis. James Gorman, as we've reported, Carol, staying on as executive chairman, and he had a big interview today with none other than Sonali Basak.
She joined us on Zoom in New York City. Sonali, great interview. I highly recommend, if anybody missed it, go to Bloomberg.com or check it out on the Bloomberg terminal. What did you want to know? Because this was his first interview, right, in his new role.
He has other roles in his life, which I think are equally interesting. One is as a nominee to the board of Disney, for example. And he's the executive chairman remaining at Morgan Stanley still. There's been a lot of questions about... Oh, sorry, guys. I'm traveling to another meeting.
Listen, Sonali is a busy individual here, and she is like bopping around on the screen. She's got a jacket on. I think she's like getting ready to maybe either she just got there.
I think she's in the back of a car on her way to her next interview, right?
This is what she does. All right, keep going.
The first week on Wall Street of this year. So, but yeah, he has other jobs too. He is the executive chair of Morgan Stanley. He's a nominee for the board of Disney. He has a significant role at Columbia Business School at a time where we know many college campuses are facing a lot of pressure. I asked him about that and what he thinks, whether he would take an even bigger role at a university, and he says it's not something he shies away from, and that a difficult discourse on campus has happened for as long as he's been in academia. So a lot of other roles, but one major question has always been, when does he start to really sever ties more in Morgan Stanley's leadership ranks?
Do you have your seatbelt on? Do you have a seatbelt on?
I'm a Jersey girl. Are you supposed to wear your seatbelt in the back seat?
I'm just saying, yes. Oh my God, you put a seatbelt on.
Okay,
right,
we'll give you We'll give you a chance to put your seatbelt on.
Yes.
Carol and I will chat very briefly.
You're
and then I'm
making
gonna
us
ask you my
nervous.
next question.
We don't want anything to happen to you. We've got, bank earnings coming up next week.
Okay, so we talked about a 14-year run for James Gorman, Shonali. What is his legacy at Morgan Stanley?
His legacy at Morgan Stanley is really flying in the face of adversity. When he first took over, and I did ask him this, was he ever worried about being ousted at the beginning? Because a lot of people did not believe in his turnaround plan. I remember Mike Mayo, the famed analyst, really pressing him to set the bar higher. They had to cut a lot of jobs. They faced significant losses, but he did turn around the bank with a lot of conviction on what his strategy was. Now, the big question is, what are those big strategic decisions going to be for Ted Pick, his successor? One fascinating thing is that Morgan Stanley is largely a U.S. wealth manager. Wealth is one of the most popular businesses now on Wall Street, and I asked him whether he could see Morgan Stanley becoming a bigger international wealth manager, and he said yes. I've covered Morgan Stanley for almost 10 years, and that's an interesting prospect. Let me put it that way. I would have bankers at rival firms always worried about Morgan Stanley's desire. There was a point at which there were bankers worried about Morgan Stanley one day buying Credit Suisse and expanding internationally. So how they do this will be interesting to see from Ted Pick, who has traditionally come from the institutional securities side of the business, that is trading and investment banking.
Right.
And remember also, Morgan Stanley 8 years ago was the number one in investment banking. They have fallen behind Goldman Sachs. And so we've had Ted Pick recently tell me that investment banking is going to lead this cycle. So are they going to get competitive with it or not?
Well, really cool stuff. You also talked with him about crypto, specifically about a spot Bitcoin ETF. Let's play that out for our viewers and listeners. Check it out, everybody.
The approval, actually, or the lack thereof, of a Bitcoin spot ETF in the United States. When you think about what wealthy clients invest in, when you think about the future of wealth management, do you think Bitcoin is a suitable investment?
I've never been, I've never really understood the value of Bitcoin as a form of stored value. Others have, and others have made a lot of money on it. I joked once, I wish I bought it at $60, and I'm glad I didn't buy it at $60,000. It's clearly speculative. I think it should play for wealthy people a very small role in their financial fabric because it's so speculative, it's so volatile, and again, it's going through enormous regulatory change and industry disruption, as we've seen with some classic failures of late. So, listen, Bitcoin's not going away. It's not a fad. I just don't think it's a core investment. I think it's a speculative asset of which there are plenty of choices.
All right, so James Gorman, Executive Chairman of Morgan Stanley. So not a core investment or asset, he said, Shonali.
The interesting thing about this is that so many people in the Bitcoin community, Mike Novogratz included, where Galaxy is one of the potential sponsors for something we'll see approved or not approved in the next week or so, believe that financial advisors and the wealth channel will open the floodgates to the Bitcoin world, buying ETFs and getting a lot of exposure. But then you have the former CEO of one of the biggest wealth managers in the world, James Gorman at Morgan Stanley, saying that Bitcoin should be a very small part of your portfolio, very directly saying so. And so it begs the question of how much interest there actually is going to be in Bitcoin moving forward from this channel.
Yeah, it's a good thing. Well, listen, incredible interview. Thank you for putting your seatbelt on. We don't want anything to happen to you. That, of course, is our Shonali Bosick, Bloomberg News Wall Street reporter, with her first interview for James Gorman since he's taken on all of these new roles. We know the news isn't new. We knew he was going to step down. We got this over the summer or the summer, and the transition happened at the first of this year. But really fascinating to hear him weigh in on different things. So if you missed it, head to the Bloomberg terminal or go to Bloomberg.com.
I also think, and Shonali mentioned this, it's part of this bigger story, Carol, about these bank CEOs who were in place in the wake of the financial crisis now handing the baton to their successors.
But he wasn't there during the financial crisis.
He wasn't there post-financial crisis, exactly. Jamie Dimon now is the only one who was there during the financial crisis.
It's pretty remarkable.
And it shows how long he's been there, and that's why there's so many questions about his legacy, or his next move.
Right.
And, he has the saying 5 more years. But it comes at a time, too, when, JP Morgan hit a record yesterday.
That's right. I think it's interesting, too, and it's why we always, we're going to get those bank earnings starting next Friday, right? Thursday, Friday? Friday. And when Jamie says something, why it is so important.
This Friday?
No, next Friday.
Okay.
A week from Friday. We get jobs on Friday and then a week from Friday.
Okay.
Sorry if I freaked everybody out. But it's someone who has seen real severe stress in the financial system, some would say, coming undone during the great financial crisis. And so when we are in another moment, whether it was the regional banks or some other particular moments of question or concern, he is a voice that you like to hear from.
Hey, also...
What?
Everybody go check out Shonali's interview.
Yeah,
you
great
can
stuff.
check it out at Bloomberg.com. You can check it out on the Bloomberg terminal. They covered a ton, including the proposed bank rules. That was a big part of the interview.
Yeah.
And then talking about rates this year. Also, just kind of how he thinks about management, which I thought was really interesting.
Right, exactly.
Mistakes.
Yeah, exactly,
Yeah.
right. You always love somebody. He's very real in terms of conversation. Hey, speaking of the banks, I'm looking at the KBW Bank Index, folks. It's down almost 2%, 1.9% as we speak, on a day when we are seeing, to the equity side, things are lower pretty much across the board. Looking at the regional bank, the KRE ETF, it is down about 3.4%, so taking a little bit more of a hit in today's session.
And the overall indices still in the red today. The NASDAQ down a full percentage point. The S&P 500 down 0.6%, while the Dow Jones Industrial Average down 0.6%.
All right, all right, everybody. Time now for a check on world and national news. Off to D.C. we go. And Nancy Lyons. Hey, Nance. Happy New Year.
Thanks, Carol. You too. Iran says twin bomb blast killed more than 100 people today with no immediate claims of responsibility. This happened at an event marking the 4th anniversary of the death of a top Iranian general who was killed in a U.S. airstrike. During today's White House briefing, National Security Council spokesman John Kirby was asked about the attack.
Our hearts go out to all the innocent victims and their family members who are obviously, their lives are going to be forever changed by this. But we don't have any more detail in terms of how it happened or who might be responsible for it.
Kirby says they have no indications Israel was involved, and Israeli officials have made no comment. The sound of happy Ukrainian soldiers freed today in a prisoner swap with Russia. 248 Ukrainians were handed over and 230 Russians. The United Arab Emirates helped negotiate the transfer. Fewer workers have quit their jobs. The number of new hires has fallen and job openings have decreased, according to the latest government report. This is manufacturers reported an optimistic outlook. Bloomberg's Irv Chapman has more from Washington.
The manufacturing index compiled by the Institute for Supply Management improved last month. Timothy Fury, who chairs the group conducting the survey, commented in a Bloomberg interview.
Although the new order number did come down, there was enough new orders and stable production output to slow the rate of backlog decline, which is really good. New export orders improved. Given the signaling that's happening here, I would expect that demand is going to improve in the first quarter for sure.
Fury said investment in new facilities is rising and interest rate cuts would provide an additional boost. In Washington, Irv Chapman, Bloomberg Radio.
The eastern U.S. is bracing for what's expected to be a stormy weekend. Forecasters say many in the Northeast and Mid-Atlantic could see the first significant snow of the season. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
minutes, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ very much in the red. 20 minutes to go until that closing bell clangs on Wall Street. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks under pressure from the start today, with the Dow currently down 210 points. S&P's dropped 29, and NASDAQ is lower by 1%. The U.S. 10-year yield at 3.9%. Gold is down 18, but oil is climbing. And Bitcoin plunged early this morning, falling as much as 9.2%. Among the main 11 S&P sectors, only energy and telecom were in the green. Real estate was under pressure. And leaders to the upside in the Dow, Chevron and Merck, while Boeing and Caterpillar led to the downside. In deal news, Cigna is in talks to sell its Medicare business for $3 to $4 billion. And in other news, Barkin said the potential for additional rate hikes remains on the table. Wrapping things up, Cal-Maine Foods reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, to hear live breaking news over your Bloomberg Time Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, Tim, getting ready to wrap up the second trading day of 2024.
What a year, Carol. What a year.
Can we do that already?
Market's down for the year.
Are you ready to make a call?
I'm ready. No way. Never. Saw how that worked out last year for all those analysts.
You're like, I think I'll wait a little bit.
Yeah, not going to happen.
All right, we are, though, definitely seeing continuation of some selling here. NASDAQ, as you just heard from Charlie, the worst on a percentage basis, down about 1%. So let's see what our guest has to say. Let's get to the drive to the close. Dave Donabedian is CIO over at CIBC Private Wealth Management, joining us, back with us on Zoom from Baltimore. You shared with us, first of all, Dave, Happy New Year. Nice to have you back with Tim and myself. In the notes that you shared with us, when we look at the economy in 2023, you point out it really did exceed expectations on all fronts. It's not exactly the playbook everybody was predicting a year ago now, or, at the end of 2022, heading into 2023. Everybody thought the world was going to come undone.
Right. I mean, the consensus forecast, particularly for the second half of 2023, was for a recession. The idea being that we had a significant tightening of monetary policy, an inverted yield curve, a big decline in the index of leading indicators, et cetera, et cetera. And of course, it didn't happen. And the economy certainly performed above my expectations. I think the question now is what happens next. If you look at the consensus view, it's almost as if a lot of the people who thought there was going to be a recession last year, when it didn't happen, just said, oh, well, I guess we're not going to have a recession ever. I hope that's true, but it's not likely. I still think that this coming year, well, now this year, 2024, I don't know if it'll be a recession, but I think it's going to be a year of kind of stagnation to very slow growth, slower growth than we've seen in any of the prior 3 years. And I think maybe that's one factor that the current, kind of very rosy scenario pricing of markets isn't taking into account.
So do you think there are further declines ahead as a result of the way that you think the economy is going to move in 2024?
Well, look, we finished the year up 9 weeks in a row to close out 2023. So at a minimum, we're due for a breather, and we're seeing that here over the last couple of days. But I do think when you have an equity market priced at 20 times forward earnings, and when the earnings are probably too aggressive, you're due for a bit of a pullback, and so it wouldn't be surprising to me that we see that unfold here in the first few weeks of the year. I do think, though, that the biggest occurrence we're going to see this year, and maybe it's not until later in the year, though, is what I call the conditions that will set forth a multi-year sustainable bull market. I know a lot of people use the word bull market or the words bull market to describe last year. And I realize someone somewhere long ago decided if the market goes up 20%, we call it a bull market. To me, though, we're still on a sort of a round trip journey. We're at the 2-year anniversary of the all-time high in the S&P 500, and we still haven't kind of quite recaptured that yet. But I think as 2024 advances, we are going to begin to get those rate cuts from the Fed. It's going to be clear that it's not going to be one rate cut. It's going to be a progression of them. And that's typically been a green light for what I'll call a real bull market, where you move to sustained and repeated highs.
What about the move that we saw in small caps late last year, kind of breaking out, right? We did see a broadening of the rally, which was healthy, most would say. But I'm looking at the Russell today is down about 2.6%, so really taking it on the chin. And that to me speaks to maybe some concerns about what could happen here in the U.S. economy this year. And if we get a Fed that overdoes it and turns us into some kind of a recession, what are you advising to clients at this point? Should they be going after the winners of late last year? Should they be broadening out, looking at those undervalued names? What do you suggest?
Yeah, I think broadening out, and we're pleased to see in November and December, all right, the strong market rally wasn't all about the Magnificent Seven. We had very, very broad participation, including and especially, as you point out, in small caps. So our message is that you could argue diversification didn't work in 2023. The best performance was being clustered into those handful of stocks. I think it will be more important, and we will see, if you will, sort of broader prosperity across markets, including small caps. They're getting hammered today, but the valuation differentials there relative to large caps are pretty extreme, even with the small cap rally that occurred late last year. And you're right, economic weakness can be a concern for small cap investors above others, but small caps also love rate cuts more than any other part of the market, and that is to come. So we actually kind of like the small and mid cap sector.
So you think the rate cuts haven't necessarily been fully priced in? That's what I'm hearing from you.
Well, I think there's a little bit of a divergence, right? The Fed has led us to a 75 basis point expectations. Markets are saying now twice that. We're going to see 150 basis points of rate cuts. 150 basis points of rate cuts, to me, only happens if we get the economic scenario I mentioned, where, in fact, at least concerns about recession kind of creep back into the market. I think that's going to happen, and so I think we'll see at least 150 basis points of rate cuts this year, and more than 150 certainly isn't in the market. And we kind of had the FOMC minutes today saying the opposite, which is you might be getting ahead of yourselves if you're looking at twice what the dot plots say. So it's going to be, as always, it's going to be data dependent.
Well, that's what I was going to say to you. I mean, and we're asking you to kind of make some calls here. Having said that, the first Fed meeting is January 31st, then we've got one March 20th. But I do feel like we all kind of have to slow our rolls here, because there's a lot of different scenarios that could potentially play out in terms of Fed policy, in terms of geopolitics. We haven't even brought into the U.S. fiscal situation. We've got a November election. I just feel like there's some significant...
That's it?
I'm already like, okay, bring me to 2025.
Well, I mean, you raised a really good point, Carol. I mean, David, what do you think is the biggest risk or the biggest sort of thing that you're looking at this year?
In just about 30 seconds.
Right. I think it's that economic growth does not achieve expectations, which means that profit growth doesn't achieve expectations, and that could take a multiple point or two out of the markets before we get let's call it the benefits and the positive sentiment around Fed easing.
Sounds
so
like
it could be challenging.
Yeah, so even anemic growth, right? It might not be technically a recession, but it's going to feel like one, especially when prices maybe not going up, but they're still at high levels. We have to remember that. Hey, Dave, thank you so much. Dave Donabedian, CIO over at CIBC Private Wealth Management, joining us on Zoom from Baltimore.
I thought he was going to say the election.
I know. It's a big deal, I think.
Very big deal.
No doubt about it. All right, everybody. This is Bloomberg Business Week.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Walt Disney says it has won support of Value Act Capital Management for its board nominees and will consult with the activist investor on strategy as the world's largest entertainment company responds to pressure to boost performance. Walt Disney shares, they're up right now by 1%. Morgan Stanley Executive Chairman James Gorman spoke exclusively this morning with Bloomberg Radio, and in that interview, our Sonali Basak asked him about mistakes running Morgan Stanley.
If you look at the major things that we did, whether they were the deals, Smith Barney, E-Trade, Eaton Vance, succession, which is critical, navigating through COVID, we got frankly most of the big stuff right. I wish we hadn't sold Van Kampen when we sold it to Marty Flanagan and Invesco. So that was something. I think it took a little too long to get the full team that I wanted in place in the right jobs. But you can't do these jobs and not make mistakes. When I see a mistake, I embrace it.
BP and Norway's Equinor have terminated their power agreement with New York State for a 1.3 gigawatt wind farm in the Atlantic, blaming changing economic circumstances that made the Empire Wind 2 project unviable. ADRs of BP up by 1.5%. ADRs of Equinor up by 2.1%. Dyne Therapeutics shares are surging after the drug developer announced initial data from trials of 2 of its therapies for patients with muscle diseases. Shares up 14%. Those are our top company stories.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, folks, just about 4.5 minutes until we wrap up this Wednesday trade. We're going to head over to our TV colleagues in just a moment. Carol Messer, Tim Stenevec here on Bloomberg Business Week. Hey, one stock we haven't talked about, I didn't put it in my gainers list.
How come? Well, it was lower earlier.
It was lower earlier.
You were worried that it wouldn't hold. It's a real risk.
Yeah, and Charlie was just talking about it too. And it was gaining just a little bit, but right now it's up about 1%, as Charlie mentioned. But Walt Disney's CEO Bob Iger lining up allies as he's looking to stave off pressure from activists, billionaire activist Nelson Peltz. But I do feel like the activists are really out to make their case when it comes to Disney right now.
Yeah, Value Act Capital Management pledged on Wednesday to support Disney's board nominees at this year's annual shareholder meeting and will consult with it on strategy as the world's largest entertainment company works to improve its financial performance.
And then at the same time, you've got activist hedge fund Blackwell's Capital, which backs Iger's efforts. They are proposing 3 nominees to the Disney board who would champion the CEO's strategy and offer an alternative.
I feel like you need a whiteboard. Do you need a whiteboard?
I feel like,
with different teams and like lines
Sock'em
connected
robots.
to people. Yeah.
You put Peltz in one, you put Blackwell on the other, and just fight it out, guys.
And Iger's in there too.
Yeah,
you gotta have Iger on the board.
He probably feels like he's like
Like
in the middle.
Yeah, exactly. You talked about the second statement today. Blackwell's tempered its support by criticizing the cooperation accord between Disney and Value Act.
Yeah, what it said is Blackwell said, today's announced agreement with Value Act is a disappointing defensive move by Disney that does not solve for anything. Bringing all shareholders a real and better choice for directors is a necessary act that will support the future success of Disney. I heard, Scarlett and Romain talking about it earlier. Iger's been under a lot of pressure since he came back as CEO in late 2022. Bob Chapek was losing lots when it comes to streaming services, had a bad kind of string of movies. Iger's cutting jobs and costs.
Superhero fatigue happening. All they need, Carol, is the 4th season of Bluey to hit Disney Plus. And then everything will be okay.
So says Arlo Stenovic.
Yeah, I mean, Bluey is like, it's the most amazing show. Episodes are 8 minutes. And we're going to pay Disney Plus forever for Bluey.
Yeah, I bet they are. You're not dropping that streaming service. Disney was down about 11% in 2023, so a little bit higher. People are expecting something. All right, if you're expecting something from us, you got it, because we're going to wrap up this trading day. We're heading over to our TV colleagues Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romain Bostic alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms. That includes television, radio, Bloomberg Originals, as well as our partnership with YouTube. Second straight day of trading here in the U.S. equity markets and second straight day of losses, Carol Massar.
Yeah, absolutely. And I'm going to a place that you like to talk a lot about is the Russell 2000. I mean, it's down about 2.6%. So if you're looking for some underperformance, as you said, down really across the board, but man, the small caps really taking a hit today.
Yeah, Dave Donabedian over at CIBC Private Wealth Management, we just spoke to him, Scarlett, and he reminded us, look, you had 9 straight weeks of gains for U.S. stocks at the end of the year. It's about time that stocks take a breather. Still, he is a little concerned about valuation multiples right now, and he thinks that earnings are not going to match, so he does expect more of a pullback. But he does say that once the Fed starts to cut rates, we could see a sustained rally that could last years.
For all the valuation concerns that people cite, though, it's usually on the big cap side and it's usually on the Magnificent Seven side. They're all saying that the Russell 2000, the small caps, they are looking pretty attractive. It's just a matter of waiting out this period where there's uncertainty and you have to get more people on board.
It'll be interesting, too, when we see participation pick back up and volume pick back up as we get into, I guess, sort of the more meat of the month. That, of course, includes the jobs report this Friday, our earnings, which are going to start in roughly about 2 weeks' time, and then, of course, another Fed meeting at the end of the month here. So there will be a lot of catalysts here. The question is whether that catalyst will be to the upside or the downside. We are getting the closing bells here in New York. The Dow Jones Industrial Average, which yesterday actually escaped having a losing day, not going to escape it today. It is lower on the day by about 0.7% here as we wait for these numbers to settle. That's basically down about 285 points, right around that 37,430 level. Meanwhile, the S&P 500, which did trade below 4,700, is going to close just above it today, but it's still down 38 points or about 0.8%. The NASDAQ Composite down 173 points or about 1.2%. And Carol was just talking about it. Let's talk about it. The Russell 2000, a 54-point decline here, 2.6%. That is, Carol Massar, the biggest one-day decline for the Russell 2000 since March of 2023.
That's a big move to the downside.
That's huge.
Right? When we think about technicians and what they watch, that feels like a technical move to some extent. But we'll see if it continues, Scarlett, to build momentum. Having said that, back to the big caps we go. And Scarlett, you definitely saw a risk-off trade.
Wait, can I just point out, sorry, not to interrupt you, before you move on to big caps, but I was just looking, because the technical levels did get breached to the downside today, and you had Russell go below that 20-day, and some of those other, those esoteric ones like Fibonacci and all that stuff that I don't really understand also have breached some of those levels to the downside as well.
That would explain the price action,
Yeah, pull up RSI. We definitely were overbought. We know that. Everybody keeps saying that about equities, but you look at it and it definitely pulled off significantly off that oversold level, guys.
All right, in looking at the Russell 2000, by the way, all 11 industry groups finishing in the red. When it comes to the big caps, and this is what you're looking at here, the S&P 500 and its 24 industry groups, autos and components, real estate investment trusts, and consumer durable and apparel leading the way down. On the upside, you had energy stocks as oil prices staged a rebound, telecom names and utilities, definitely more of a defensive tilt there among the gainers.
Well, and if you wanted to do well, if you were a bull or trying to be a bull in this market, as you just mentioned, Scarlett, energy, the top performing group in the S&P 500, definitely a bright spot, which brings me to Marathon Petroleum. With a gain of about 3.6%, up as much as 5% at its highs in today's session, but still closing the day up 3.6%. Number one gainer in the S&P 500. I do believe it might have been a record close.
Yeah, I just correct you. It's number 2 gainer. Eli Lilly actually surged into trading.
Right. Yeah. Oh, I'm sorry. All right, number 2 gainer. It was number
That's
1.
That's fine. It's only your first correction of 2020.
I want to see, Romaine, I want to see your launch pad. I want to see your screen that you've created that you just know all this stuff.
White flag. Where's my white flag?
That's what I want for New Year's.
All
it's just
It was among the top in the S&P.
There we
was
go.
number 1. Now it's number 2. Anyway, a bright spot. We know that there's tensions in the middle.
Not to interrupt again, but I was
Can
looking.
we get Romaine's wife on the phone?
In all seriousness,
yes.
I mean, I'm going through the biggest gainers in the S&P, and I mean it's all basically oil and gas stocks. I mean, with the Eli Lilly and Junipers thrown in there, but basically the top 20 names are, I think, 16 of them are energy stocks.
Yeah, exactly. Well, which brings me to another one. I'm just waiting if he's going to interrupt. Suncor Energy was also outperforming 5.8%. This oil producer said fourth quarter upstream production was 808,000 barrels per day. BMO Capital Markets said it was a positive surprise, so we saw some momentum, some specific fundamental momentum to the upside for that name. And I just want to go to, when we look at outperformance today, we did see, I haven't done this in a while, first time for the new year, NASDAQ Golden Dragon China Index outperformed.
Only 2 days in.
It's back.
She waited.
See, some things you can't just count on. We did see Pinduoduo. It was among the top in the NASDAQ 100. Chinese online retailer. What's interesting is China once again trying to bring some investor sentiment back. They approached some of the gaming regulations there, looking at some of the damage that's been caused in that sector because of harsh new gaming regulations. They did fire, I think it was their chief publicity department head, and so maybe getting rid of that person. So I don't know, the back and forth in China, but nonetheless, there was some outperformance there. Okay, I'm done.
Okay, let's look at underperformance. I want to start with Apple. It's worth checking in on shares of Apple after yesterday's round. Another down day for Apple. Shares finishing down more than 0.7%. The company is down 4%, more than 4%, just in the last 2 trading sessions. Reminder, Apple was up just about 50% last year. And then American Airlines actually down for a 7th day in a row today. Longest losing streak in more than 2 years, down 3.7%. Over the last 7 days, it's down nearly 10% compared to the S&P 500, which is down less than 1% over that same period. And then this is a really interesting one. Ticker MTN, Vail Resorts. They own and operate more than 40 ski resorts around the world, many of them in the east of the U.S. and in the west of the United States, including Vail, Beaver Creek, Park City, Breckenridge, Whistler, Blackcomb, Stowe, Okemo, and more. Shares finished the day down close to 2%. Barclays came out and said that the underwhelming ski conditions they've been seeing in much of the U.S., spurred by warmer than average temperatures, threatened to reduce the company's full-year earnings. So we're seeing some weather and maybe climate change.
Snow, what snow, right?
Exactly.
I went to Okemo over the
was
holidays. It was raining the entire time, and there's bare grass everywhere.
Did you see the pictures from Whistler?
No.
In the late part of December, there was like rain at the top of Whistler. I mean, this is an area of the country that, or of Canada, I should say, that gets like a lot of snow typically around this time.
It should be covered in white.
Should be covered, yeah, and it's been pretty bad. Colorado has like 60 to 70% of average snowpack right now. Which is okay according to the National Weather Service, but Utah has about 50 to 60%.
Well, it's supposed to snow this weekend, right?
Here in New York.
In the Northeast,
but, I mean, we're talking like
so
a couple
guys,
inches.
there's this thing called climate change, and
yeah.
I mean, it's really pretty sad in
really
terms of
sad.
some of the severe weather conditions that you're seeing, and just not seasonal. I thought about it on Christmas Day. I don't know. It's like it was kind of warm around here, and I don't know. Growing up, it used to be pretty.
Yeah, and it's not just like the skiing activities. I mean, we talked to so many at Bloomberg, so many farmers and people in the agriculture industry that tell you that corn belt has already shifted north, and you got a lot of other parts of the country now that are having to grapple with trying to grow things that maybe they wouldn't have grown in the past. I do want to talk about.
Can I just say Panama Canal? Great Bloomberg big take.
Yeah, that was a fantastic story.
Yeah, exactly.
Yeah.
I mean, that the problems that they're having because of the low water levels and getting trade through there.
Can we talk about? But it's interesting too because I mean, this is like the engine of their economy. I mean, it's basically their entire economy more or less. And now they want to sort of cut off. I got the name of that river that they want to dam up to try to get the water back in there. But then of course that hurts all the people who rely on that river for agriculture stuff. So it's a huge catch-22 here.
Yeah, exactly.
Yeah. Before we move on, I do want to talk about yields. Can we do that?
Yeah, please.
Yeah, I mean, actually, they didn't do a whole lot today, but it was interesting though to see.
Still talk about them.
But it's interesting to see the reversal from yesterday here because we did see those yields spike pretty high yesterday here. Now the 2-year yield did move slightly higher, but you see that's basically less than a basis point there. Meanwhile, the rest of the yield space moved lower here, so you did see a bid come in. I think to the longer end of the curve, which I thought was interesting here. So if that was a safety trade, or if this gets more to that rotation idea of people cashing out of equities and then trying to find a place to park that cash that's a little protected, maybe that explains this. But it's going to be a few days, I think, before we get a clearer picture here of what this price action is really telling us.
Romaine, I am a little surprised the way that yields ended the day, especially the 10-year, which hit 4% earlier and then moved lower after we saw the minutes from the Fed meeting.
Well, apparently, within the minutes of the Fed meeting, even though Jay Powell didn't say a whole lot about quantitative tightening and the balance sheet, there were some suggestions by participants that it'd be appropriate to begin discussing technical factors factors that would determine when the Fed starts to slow down the pace of quantitative tightening. And when it does that, that is another form of easing. So that's starting to come back into the conversation here.
Yeah, listen, I agree with Romain. I don't agree with him on a lot of things, but I do agree with him on this, is that I think it's going to take a while for us to settle in terms of where rates are supposed to be. I think it was overdone to the downside. I think a lot of folks are weighing in on that expectation, and that maybe a 4% level makes more sense, or a little bit above it. But I guess ultimately with the data points, how they start to play out, and we'll get an idea starting on Friday, right, in terms of that monthly jobs report.
I disagree with Carol.
Your wife's
Just for the
calling.
principle of it.
She and I are going to talk later. All right, guys, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, our second trading day of 2024. Wrapped up. Beyond the Bell. We'll see you tomorrow. United States. Apple, Tim, it's simple. It needs Chinese workers to make its iPhones and Chinese consumers to buy them.
So this would seem to make the deteriorating relationship between the two global superpowers, the US and China, uniquely dangerous for Apple. Remember, Biden launched an aggressive campaign to keep China from developing advanced semis and called Chinese President Xi Jinping a, quote, dictator. And then Xi pursued a strategy to limit China's reliance, Carol, on Western-made technology. But
back and forth, back and forth.
Apple, shares of Apple were up 50% last year.
Yeah, they did really well. So let's get into it, because while the company's floated above the geopolitical tumult so far, Apple does enter this year, 2024, in danger of getting dragged into it. So writes our next guest. Not a guest. He's a friend of the show, friend of the family. Bloomberg Business Week columnist Max Chafkin, who joins us here in our Bloomberg Interactive Brokers studio. His story, by the way, in the new issue of Bloomberg Business Week, which is already, by the way, the story available at Bloomberg.com/businessweek and on the Bloomberg terminal. Happy New Year.
Happy New Year.
It's going to be Happy New Year for Apple.
Well, you know, I mean, look, Apple is a big and powerful company, and what we're talking about are certainly challenges, but probably not existential challenges. I mean, when you take a few steps back, there are a few companies that are as sort of bought into the idea of U.S.-China relations being fairly warm. And that goes back decades. When you talk about Tim Cook, where did he come from before he was CEO of Apple? He was essentially the architect of this supply chain, the supply chain that relies on these big outsourcers, most of them operating factories in China to manufacture phones, and relies on a market, a market that has grown, you know, tremendously and has done really well by Apple over the past few years. You might have thought during the Trump presidency, you know, Trump, a lot of anti-China rhetoric, a lot of rhetoric about globalization. Apple did great. And one of the reasons Apple did great is because although the trade war did not affect Apple, it did affect Apple's competitors, primarily Huawei. Mm-hmm. So for several years, Huawei was essentially frozen out of the market for high-end chips. It had, in 2019, Huawei actually surpassed Apple in terms of handset sales globally, in terms of units sold. And then it basically fell off a cliff because it lost access to semis, to the high-end semis. And what happened last year is that Huawei, basically out of nowhere, and we've talked about this before, you know, launched this new phone, the Mate 60 Pro, that has a chip that is, although it's not quite a state-of-the-art chip, it's a lot closer than it was. That phone has sold very well. Huawei is bouncing back, and that is creating problems for Apple in China at the same time that the Chinese government is introducing new restrictions that you know, the U.S. has characterized as, you know, retribution for our own restrictions. China has been sort of opaque about what they're doing, but it seems like, according to Bloomberg reporting, that many Chinese workers at state-backed companies are being encouraged or told or required not to bring iPhones to work. So you have these two sources of pressure. One is competition, the other is government regulation, and they're biting Apple, you know, in a very important market.
Max, I think a big part of this story also is the fact that the ecosystem, the mobile ecosystem in China, is not as sticky as the mobile ecosystem in other parts of the world. So here in the US, if you're an iOS or, you know, an iPhone user, your next phone is going to be an iPhone because you're like in that ecosystem. You have all the apps. But then in China, you have these over-the-top payments apps that work equally well, whether you use an Android or whether you use an iOS device. We don't have that, they don't have that stickiness that we have here with like iMessage and other parts of the Apple ecosystem.
Well, and I mean, a big point, when you think about what is appealing about an iPhone, obviously part of it is the hardware. It's very beautiful, works fast, good chip, so on. But the software part is important also. And of course, software in China and these cloud services are regulated differently. You know, Chinese users may not have access to all of the cloud services that U.S. users have access to. So that's another factor. And of course, there's been a lot of sort of media coverage around this issue. You know, in China, there's talk of sort of patriotic duty to buy, phones made by domestic companies, just as there is, I guess, to some extent, in the U.S. But until recently, that hasn't had much of an impact. And one reason it hasn't had much of an impact is because you haven't had really strong competitors. But now, talking to analysts and so on, the competitors are getting better. They're closing that gap with Apple, at a time when the government may be more interested. The government has long been interested in sort of reducing the, influence of foreign-made technology equipment, but where the government now seems to be sort of doing something, acting on that interest.
So does Apple have to be worried about China, especially, consumers wanting their devices or being able to do it? I feel like we have had bull-bear scenarios as of late in the last week or so, where there's some concerns about the uptick in China, specifically of the iPhone. So does Apple need to be worried? I mean, it also employs a lot of workers, which is a good thing for China.
So when you look at, when you hear what Apple's saying publicly, what they're saying is, they're not seeing this, they're not worried. They've sort of signaled that the softness in China was not, in the most recent quarter, was not related to this iPhone issue.
And they still sell a lot.
And they're selling a lot. And we write in the story, there are big lines, at Apple stores. The fact is that this is a device that whatever the government says or does, and whatever's happening politically, is popular with consumers. People like it, and the same way they like it here. So that is all stuff that is going for Apple. And again, when you look back historically, we've sort of talked about this, and these warnings have been swirling around for like a decade, and Apple has basically done well, has continued to grow its sales in China. Now, sales may be plateauing to some extent, but now, people are raising concerns that we may be turning some kind of corner.
Can you talk a little bit, Max, about how this is a function of Tim Cook before he was CEO? I mean, this is a guy who was a supply chain expert before he was tapped to become interim CEO and then, CEO when Steve Jobs died. How did he set up Apple in China?
Well, and this is like such a fascinating thing because people think of Apple as this design-first company, and you might think that the successor to Steve Jobs would be another, head of the clouds, creative type, and of course that's not what Tim Cook is. Tim Cook is a practical-minded supply chain whiz, and it's worked incredibly well when you look at the number of devices, the way they've been able to squeeze costs to make this thing cheaper, to maintain their profits. I mean, the huge percentage of the profits in the smartphone industry generated by Apple. It's all kind of worked well. Then again, it's built on a vision of the world that is changing, and that will continue to change, assuming that the U.S. and China tensions between those two countries continues.
On those supply chains, you're right. The supply chain diversification, right? Because Apple is looking at other places, but might be, well, it looks like it's a way to reduce Apple's exposure to geopolitical blowback. It may be having the opposite effect. And you're right, Apple's a major employer in China, and the government crackdown on iPhones could be seen as a warning about moving jobs out of the country. That part of the story just kind of blew my mind, because I don't know that we've really thought about it that way.
Yeah, so that's the thing. I mean, Apple sort of seems to have dispatched executives. Tim Cook flew out there at the beginning of 2023. A senior Apple executive made public comments, kind of a rare interview with state media, talking about the kind of joint relationship between the two countries. Apple's really interested in sort of promoting the idea that, hey, it's been a really good employer in China. Yes, it is interested in diversifying its supply chain, as are many companies, of course, because as we've seen with COVID and so on, there are reasons for that. But it's hard to escape the sense that they're in a bit of a box. They have to, or that they at least have to walk a line where they want to diversify their supply chain. They're trying to make more iPhones in India, both for reasons of diversification, because they want to reach that market, while at the same time trying to make sure that they keep those relationships in China that Tim Cook and this company have spent decades building intact. They definitely can't just turn off the iPhone factories in China. China's going to be important to Apple, for many years going forward.
God, it's fascinating, right? It's like we'll see what happens in the new year. It would hard to be Tim Cook and kind of juggling it all. Max, great piece of carry out into the new year. Max Chafkin, columnist at Bloomberg Business Week, coming up in the new issue of Business Week. It'll be out next week, but it's already on the Bloomberg terminal at Bloomberg.com. Max, thank you so much. Happy New Year. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg's second trading day of the new year. Another down day. The Dow, the S&P, NASDAQ all declined today. S&P was down just about 0.8%. That was a drop today of 38 points. Dow Industrials lower by 284 points, down 0.8%. The NASDAQ Composite Index down 173, drop there of 1.2%. The new year slump in stocks extended while bonds bonds eked out a gain in the aftermath of the minutes of the Federal Reserve's last meeting. 10-year yield 3.91% with a 2-year yielding 4.33%. Spot gold down $18 the ounce to $20.40, drop there of 0.9%. Crude West Texas Intermediate up 3.7%, $72.99 a barrel. And Bitcoin dropped today by 5.1%, 42,805 on Bitcoin. After the close of trading, we heard from egg producer Cal-Maine. It reported EPS for the second quarter that did miss the average analyst estimate. Cal-Maine, by the way, the nation's largest fresh shell egg producer and marketer. Stock trading lower after hours, dropping now by just about 7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with Tim Stanovic, live here on Bloomberg Business Week. Well, we've got one of the most read stories, Tim, that we really want to get to.
Yeah, it's about the resignation of Claudine Gay, the president of Harvard University. After only 6 months on the job, a historic elevation cut short by allegations of plagiarism and anger over her handling of anti-Semitism on campus in the aftermath of Hamas's October 7th attack on Israel.
Yeah, also a popular read today. Bill Ackman, you know him well, hedge fund dude who led a campaign to oust Claudine Gay from Harvard, said that the school's board should be removed over its support for the embattled ex-president.
With more on the tumult that has tarnished the oldest and richest U.S. university's brand, it's led to a revolt among its wealthy donors and deepened rifts between faculty, students, and administrators, is Bloomberg News higher education finance reporter Janet Lawrence. She's here in our Bloomberg Interactive Brokers studio. Janet, you've had a busy 36 hours after this news broke yesterday. The story today is really about the rifts that are exposed at Harvard University right now and the sort of the interesting way that the Harvard Corporation has a role and the Harvard Board has a role. Explain for people who don't understand the structure of the school what's exposed right now.
Well, the Harvard Corporation was 12 members up until yesterday. Now it's 11, led by Penny Pritzker, who used to be the Commerce Secretary in the Obama administration.
This is not the Board of Trustees.
Well, this is this is their Board of Trustees. Okay. And they are the governance of Harvard. They really answer to no one. And they pick themselves, and they picked Claudine Gay. For example, they picked the board of the Harvard Management Company that manages the $50 billion endowment, which, as you all know, has not been performing so well. So it's really up to them to pick also the next president. So I guess the question is, who are they going to pick, and what is that process? You know, we've heard this was the shortest process in many years that picked Claudine Gay. And if you just take a step back and look at the enterprise and look at what the president is supposed to do, 2 big jobs: keep the ships sailing smoothly and keep fundraising, because you've got to fund it's a $6 billion enterprise. And she performed neither of those roles. As we've talked about many times, donors revolted. Len Blavatnik, who's given almost $300 million to his family foundation a few weeks ago in our story, said he was halting donations, concerns about anti-Semitism on campus. You know, your average rank and file Harvard donor who, you know, may give anywhere from, you know, $100 to tens of thousands to $1 million. They're saying, no, we're not interested in donating anymore. You had people saying, I'm embarrassed to be a Harvard alum. And so fundraising, they brought in over $1 billion every year since 2014. They need that money to operate a huge budget. And then Washington funds 11% of their budget.
I find this fascinating. Talk about this.
So we quoted in today's story Professor Avi Loeb, an eminent scientist. He happened to be in Washington the very day of her testimony, you know, meeting with lawmakers about, you know, a physics project. And that just really underscores that's what Harvard funds, this, you know, these amazingly brilliant professors and their research. And it's quite a lot of money, hundreds of millions of dollars every year. And you don't want to jeopardize that flow of money. Also, every year, you know, last year, Harvard students got $105 million in federal student loans. Now, we know that they're very generous with undergrads. You know, they're funding, you know, $250-ish million a year on financial aid for undergrads. But, you know, your average Harvard Business School student or Harvard Law School taking loans to cover, you know, $110,000 in tuition every year. It's, you know, you can't really rock that boat.
Well, this is where money complicates everything, right? I thought it was interesting in a story you reminded us that over 700 faculty members supported the president and vocalized their support for her following the congressional hearing, signed a petition defending the independence of the university, urged its leadership, quote, to resist political pressures that are at odds with Harvard's commitment to academic freedom. I do feel like, Tim, we've been talking about a lot in the newsroom about freedom of speech and academic freedom, which has become tortured, not just in the last year or the last month or the last couple of months, about welcoming different points of view and perspective on campus. And I do wonder how you were thinking about this, not at Harvard, but just more broadly at private institutions, academic institutions.
Well, it's been a huge criticism of Harvard. We had an example in a story we did earlier this year about Stanford's president resigning.
Right.
Don't forget there were research flaws in his work. There was an incident where a conservative judge came in and he was shouted down and couldn't speak, and the school apologized. They were quite embarrassed. And that's just not acceptable, is what they said. You have to have different viewpoints. And when you go out into the real world, you need to understand you're in a workplace like Bloomberg and other places that not everyone is going to share the same opinion. You still have to function in society.
But donors don't necessarily agree, or they're voting with their dollars if they don't. What do you think?
But they do think that there has to be different points of view, and that should not be shut down. And that's criticism Ackman's talking about a DEI agenda, is you have to have different viewpoints, and you have to embrace that diversity of thought. It's not just plain old diversity race, it's diversity of thought and having differing opinions.
Well, Janet, based on your reporting over the last few weeks, was Gay's ouster resignation, would it have happened had these plagiarism allegations not emerged?
It's a good question. I think that the plagiarism pile-on, if it wasn't just one instance or a few instances, people are criticizing the conservative press, but they did a very good job in exposing really what Harvard should have figured out on its own. And it was just,
because she was on the faculty right before.
Yeah, a long time.
Yeah.
And, it's interesting. If you were doing a search for a CEO of a public company, you would have had to figure out, actually, really do a deep dive into somebody's background. And that just didn't happen. I guess it was assumed because she had been given tenure at Stanford and then she came to Harvard. But it, didn't really shake out.
Well, to follow on that, if the academic issues or concerns had come up, or the plagiarism concerns had come up without, that we didn't have
the hearing,
the Mideast tensions or the war, would she have been out on that alone?
Probably not. You can't expect what is going to happen during your presidency.
Yeah.
There's always going to be something that you're going to have to deal with that, it wasn't on your bingo card. You would have never expected it. And you have to deal with things like that. And it just became untenable. It was anti-Semitism. It was how she handled herself in the hearing. One of the criticisms that you keep hearing is students are there to learn. They're not there to be disrupted in their basic econ class when protesters come in. Why was that continue to allow?
If we're worried about their life, if there's tension and stress, right?
There was
threats.
Absolutely. They just want to take their tests and move on. And the majority of students just want to be students and not be involved in a lot of this.
I think about apartheid, go back. I just remember the protests on Columbia, at Columbia. And if you didn't have some of those protests and pressure put on schools, the amount of important attention that needed to be, drawn to what was going on in South Africa. So, I'm trying to figure out what's the way forward on what I always think in academia, you have to embrace different points of view and be able to protest peacefully.
Hey, Janet, I just want to end with sort of a big picture question here, which is one about context. Why should people who didn't go to Harvard, have no connection to Harvard or the Ivy Leagues, care so much about this story? I mean, every time you write a story about this, it's like the most read story on the Bloomberg terminal.
Yeah.
This is front page news across the country. But Harvard serves a very small number of people relative to the U.S.
You just have about 50 seconds.
They have an outsized influence in the world. I mean, they are the richest university. They can afford a scholarship to be looking at the most important problems. Look at how many Nobel Prize winners come out of there. Really important thinkers. They have the means to do really important work. And you don't want to get sidetracked. Again, you don't want Avi Loeb's funding to be threatened for the most important physics problems that the world can benefit from because of decisions that have really united Congress against Harvard. There were 80 Democratic Congress members joining Republicans to condemn their testimony. How does Harvard unite the Congress against them? And don't forget, you have the left and the right. The left was upset about legacy admissions, too.
Unbelievable. That's right. Read Janet's story. It's among the most read. Bloomberg News higher education finance reporter, Janet Lauren. Janet, thank you.
Hey, let's get to Washington, D.C. now for checking the latest world and national news. Nancy Lyons is in the Bloomberg 99 newsroom. Hey, Nance.
Thanks, Tim. A large delegation of Republican lawmakers is in Texas today to get a first-hand look at the southern border. House Speaker Mike Johnson led the group of about 60 in their visit to Eagle Pass.
The president can and should act now. This doesn't require legislation. It requires leadership. And despite the White House's claim, he has all the authority he needs right now under existing federal law to stop this madness.
Enrique Morones, executive director of Gente Unida, a human rights border coalition, says migrants are misunderstood.
They don't want to become citizens. They want to become residents. They're looking for a life, not necessarily a better life, but a life to escape the violence, the environmental situation, the politics.
An agreement on border policy would unlock GOP support for President Biden's request for additional aid to Ukraine, Israel, and other U.S. security priorities. Iran says today's attacks that killed almost 100 people in the central part of the country were carried out to punish its stance against Israel. The U.S. says it does not believe Israel was behind the blast that took place on this, the fourth anniversary of the U.S. strike that killed a top Iranian military leader. Health officials are concerned about the rise in respiratory viruses. According to the CDC, more than half the country is seeing a spike in COVID, flu, and RSV. Dr. Nilesh Patel is the chairman of the emergency medicine at St. Joseph's Medical Center in Paterson, New Jersey, where COVID cases have tripled in the past month.
They are sicker, especially patients that are the most vulnerable, that have comorbid disease, things like cancer or respiratory disease.
Patel and CDC officials say if you do come down with a respiratory infection, make sure you limit your exposure to others. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, it's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. 4 losing days in a row for the NASDAQ 100 index. The new slump in stocks extended. The New Year slump in stocks extended. Bonds eked out a gain in the aftermath of the minutes of the Fed's last meeting. S&P 500 index down 38 points today, a drop of 0.8%. Dow Industrials down 284, lower by 0.8% as well. NASDAQ was down 173 points, a decline today of 1.2%. 10-year yield 3.92% with a 2-year that's yielding 4.33%. Gold down $18 the ounce to $2,040, a drop of 0.9%. Crude oil rallied 3.7%, back above $73 a barrel, $73.02 for West Texas Intermediate crude. Bitcoin today lower by just about 5.5%, 42,856 right now on Bitcoin. So another down day, 2 in a row for the S&P 500 index. Dave Donabedian is Chief Investment Officer at CIBC Private Wealth Management. And right here on Bloomberg Business Week, he told us after 9 weeks of gains, we are due for a pullback, but longer term, he remains bullish.
We're at the 2-year anniversary of the all-time high in the S&P 500, and we still haven't kind of quite recaptured that yet. But I think as 2024 advances, we are going to begin to get those rate cuts from the Fed. It's going to be clear that it's not going to be one rate cut, it's going to be a progression of them. And that's typically been a green light for what I'll call a real bull market, where you move to sustained and repeated highs.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Roku, the maker of TV streaming boxes and software, is debuting its first high-end TVs in a bid to continue sales momentum for the company's devices. Tech stocks moved lower today. Case in point, Roku, it was down just about 2.7%. Recapping, stocks lower, S&P down 38, drop there of 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Check out the new Bloomberg Business app featuring Apple CarPlay and Android Auto. You can listen to Bloomberg Business Week and all of our Bloomberg radio programs, including this one, anytime. Just download the Bloomberg Business app on your smartphone and connect your phone to your car. It's free in the Apple App Store or on Google Play.
Love that. All right, you can listen to us anytime.
You have CarPlay?
No, I don't.
Oh,
John
gotta
does
get a
actually
new-
in his car.
Okay, all right.
I don't.
CarPlay's great.
I need a new car, is what you're saying. So I can have CarPlay.
Well, I don't have wireless CarPlay. I have wired CarPlay.
Oh,
which
so
is so like the newer cars, like when we rent a car,
Yeah.
and it all goes wirelessly. That is cool.
All right, it's
Yeah.
going there. It's going there. All right, so we're going to switch gears a little bit, talk a little bit about the healthcare world. According to the Centers for Medicare and Medicaid Services, U.S. healthcare spending grew 4.1% in 2022 for a total of $4.5 trillion. That's about $13,493. Sorry about that.
I saw that number and
per person. That's a lot.
it is. We spent way like when you have a kid.
You spend a lot more.
Yeah, when
Major
the birth of
surgery,
a kid,
you spend a lot.
I was like, oh, we spent way more than that last. Well, fortunately, we didn't. Our insurance company did.
Yeah,
but,
exactly.
Carol, spending on healthcare accounted for 17.3% of U.S. GDP. Needless to say, there is a lot of money in healthcare.
Our next guest comes to us from WellSky. It's a B2B tech company. It provides tech services for healthcare providers, insurance companies, social services providers, and a lot more. It is backed by the private equity firms TPG and Leonard Green and Partners. The company, Tim, has a great read on the money flows throughout the complex healthcare ecosystem and where efficiency can be found. I'm hearing IT spending.
Yeah, Amy Shellhart is Chief Solutions Officer at WellSky. She joins us on Zoom from Springfield, Missouri. Amy, Happy New Year. How are you?
Thank you. Happy New Year. I'm great. Ready for wonderful 2024. Thanks for having me.
So explain for the layperson what exactly WellSky powers.
Well, WellSky powers, as you said, technology, services, and analytics that support over 20,000 clients. And to sort of put that in perspective, it's about 2,000 hospitals, 130,000 providers. If you think about care being provided in the home, it's 1 in 3 home care-based providers utilize our system, over 5 million caregivers. So a lot of the technology, again, the services, and the analytics that help them do their jobs every day.
Well, I said to our producer this morning when we were getting ready and prepping for our show, and we were talking about your company and you coming on, I said, so it's like back office. Is that what it is, or is it infrastructure, tech infrastructure?
It's It's actually all of that, right?
Okay.
So when we think of back office, we think of things that power the operations, right? Think of a home health agency, a back office is how do they do scheduling? How do they do billing, right? Those pieces, our solutions do those. But also, how do they deliver care in the home? How do they engage with patients via telehealth or video visits? How do they determine how to assess a patient and what types of content that they need to provide the patient from an educational perspective? We run the full spectrum of all of those, both in home as well as in specialty care areas like LTACs and SNFs, in home infusion, really all of post-acute care. And our solutions also power discharge planning in hospitals as well.
So talk to me about what you're seeing from the hospitals, from the insurance companies at the end of last year and going into this year. I mean, Carol said IT spend, certainly a big part of this. How is spending right now?
Well, it's a huge piece of it, right? As you mentioned, healthcare spend really in our country continues to be something we're all challenged with. I think what we're seeing from our providers is they want to make sure as those spends increase that they're getting more ways to augment and support their very limited staff. And so that if sort of thinking about the trends of what are our clients saying, look, their most costly expense is their staff, and staff are becoming harder and harder to come by. We're seeing shortages both in skilled and non-skilled care. In fact, in the next 5 years, we're expecting to see a shortage of 3.2 million essential low-wage, healthcare workers. And so they're really looking to us as technology services and analytics providers to help them with technology solutions that allow them to work with less people, but process more patients. So if you ask, what's happening as we look at from last year coming into this year, we're still seeing our healthcare systems, heavily utilized. Still dealing with large, volumes of COVID patients. We're seeing increased discharges to skilled nursing facilities, increased discharges to home health, which means that patients are coming out sicker. They're not able to just go home on their own. They're needing to have follow-up care, skilled care, either again in skilled nursing facilities or the home. So a lot of pressure on the healthcare system in general.
What's cool with talking about this with someone like yourself, your title is Chief Solutions Officer, so you're obviously working with companies to kind of figure out how you guys can help them with some of their back office or IT spend and needs, if you will. Having said that, Amy, we are at this interesting point, new year, we're kind of thinking and trying to figure out what comes ahead. There's a lot of questions about that in terms of the economy, what the Fed does, how that impacts growth potentially. So having said that, IT spend is always an important indicator, we always feel. How would you compare the IT spend and what you're getting from some of the clients that you work with in figuring out solutions? Is it going down compared to, I don't know, what's the smart metric, the past 6 months, the past year? Is it slowing down? Are companies thinking really hard before they do an additional IT spend right now here on January 3rd, 2024?
That's an interesting question. We are seeing more scrutiny. So I think to that point, we are seeing more scrutiny of the spend. We're being asked to deliver more outcomes and value, which frankly we embrace. And what I mean by that is they know they have to spend the dollars because they have to solve these problems, like these staffing shortages problems and the higher volumes of patients that they're seeing. So what they're saying to us is, as we spend this money, we want, in some cases, shared risk. So tell us what kind of outcomes we're going to achieve with your technology and go at risk with us so that if those outcomes don't emerge, you have a little bit of skin in the game. We see longer cycles for making decisions. We're seeing some of that, longer decision-making cycles. But I would say in general, they're still spending money. They're just being more scrutinous in terms of what the expectations are, I think in a really good way.
Not in a recessionary way? Just quickly.
I think I will tell you that while we have seen the cycles take longer, we're still having those effective sales processes.
Okay.
But the conversations are getting tougher. And again, I will give them credit for that. Conversations getting tougher around show us the outcomes, show us the ROI.
Great context.
The ROI we're going to get. Yeah.
That's very interesting.
That's interesting.
Yeah. Amy, thank you so much. Amy Shellhart, Chief Solutions Officer over at WellSky, joining us on Zoom from Springfield, Missouri. Conversations on IT spend getting harder. That's my thought for the day. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Xerox shares down 12% today after the company said it is targeting a 15% workforce reduction. Xerox calls it a reinvention and operating model evolution. The documents company says 3 key reinvention priorities include a focus on print, digital services, and IT businesses services. Xerox shares again today down 12.1%. Walt Disney says it has won the support of Value Act Capital Management for its board nominees and will consult with the activist investor on strategy. Disney shares advanced today on a down day for the rest of the market by 1%. And with more on the Disney story, here's Bloomberg's Kimberly Adams.
Charlie, it comes as the world's largest entertainment company responds to pressure to boost performance. The two companies say Value Act has signed a confidentiality agreement that enables Disney to provide the firm with additional information. Value Act's backing may strengthen Disney's chief executive officer Bob Iger's stance against billionaire activist Nelson Peltz, who's proposed that he and ex-Disney chief financial officer Jay Rasulo join the board. Disney has been under pressure from investors to improve its performance following billions of dollars in losses at its streaming services and a string of disappointing movies from its film studio. Charlie?
And that's Kimberly Adams reporting. Amazon's push into video advertising will boost annual revenue by as much as $5 billion. This is according to an analysis by Bank of America. Amazon down today by 1%. Those are our top company stories at this hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. Carol Masser and Tim Stenevec live in the Bloomberg Interactive Brokers studio. A redhead crossing the Bloomberg terminal right now. Trump asking the Supreme Court to overturn the Colorado ballot ban. That's according to the Washington Post.
He's continuing to fight those bans on the ballot. So we've talked about this story. It was a big thing in kind of late 2023. But of course, this is going to continue and the legal wrangling will continue on.
Hey, let's do a little bit more news. Let's get to Nancy Lyons. She has world and national news in D.C. Hey, Nance.
Thanks, Tim. More than 60 Republican House members have spent the day in Eagle Pass, Texas, to press the issue of soaring migration. Bloomberg's Irv Chapman has more from Washington.
Speaker Mike Johnson said if President Biden reinstated the Trump Remain in Mexico policy, border crossing would plunge by 70%.
America is at a breaking point. It is an unmitigated disaster, a catastrophe. And what's more tragic is that it's a disaster of the president's own design. Under President Biden, America has laid out a welcome mat to illegal immigrants, smugglers, and cartels.
Johnson touted the bill the House passed to resume construction of the border wall, make it harder to gain asylum, and require employers to verify the immigration status of their workers. In Washington, Irv Chapman, Bloomberg Radio.
The U.S. is calling on the UN Security Council to take urgent action against Yemen's Houthi rebels for attacking ships in the Red Sea trade route. National Security Council spokesman John Kirby says the U.S. is not alone in pressing for a response.
Countries are more and more becoming aware of this increasing threat to the free flow of commerce in the Red Sea by the Houthis, and are increasingly being willing to express their discomfort with that.
Kirby says those denouncing the attacks include more than a dozen countries. The Houthi rebels claim their attacks are aimed at ships that are linked to Israel or heading to Israeli ports, even though recently there appear to be no connections at all. Another top Republican is now endorsing Donald Trump for president. House Majority Whip Tom Emmer announced today he's backing the former president, solidifying support for Trump among all 5 members of the House GOP leadership. Emmer's endorsement is notable as Trump helped tank the Minnesota Republicans' speakership bid last year. President Biden is taking aim at his top challenger, Donald Trump. On Saturday, he plans to speak near Valley Forge in Pennsylvania, a Revolutionary War site where he will cast Trump as a threat to democracy. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Carol and Tim.
All right, Nance, thank you so much. We're going to stay with world and national news, actually national news. We want to talk a little bit more about that headline that just crossed from the Washington Post. Donald Trump asking the U.S. Supreme Court today to ensure he can appear on primary ballots across the country this spring by invalidating a ruling from Colorado's top court that said Trump is ineligible to serve as president again. I am reading from the Wall Street Journal, Washington Post, excuse me.
Yeah, remember, and I'll read from the article as well, Carol. Remember last month, the Colorado Supreme Court concluded that Trump engaged in an insurrection before and during the January 26, 2021 attack on the U.S. Capitol, and as a result could not appear on the state's primary ballot. This marked the first time a court has said a candidate could be removed from the ballot based on a post-Civil War provision of the U.S. Constitution that bars insurrectionists from holding office.
Just a reminder, too, again, from the Washington Post last week, we talked about it, too. Bloomberg was covering it. Maine's Secretary of State announced that Trump would be barred from that primary ballot as well, a decision that Trump has appealed in state court and could eventually make its way to the U.S. Supreme Court as well. You know, some of the analysis that we've been reporting on and writing about is ultimately we've got to figure out who can determine whether or not the former president can be back on the ballot.
The Supreme Court.
And I guess that's maybe if it gets, but does the Supreme Court say no? They kick it back to the lower court. Somebody's got to figure out who decides this.
I think the challenge with kicking